Change is coming to the troubled housing industry.
We need to wind down Fannie and Freddie and substantially reduce the government's footprint in the housing market.
Sweeping reforms proposed by the Obama administration will mean less risk for taxpayers and higher costs for borrowers. The administration has proposed 3 scenarios to fix housing and is kicking the can over to Congress to come up with a solution. The options on the table: no government role except for existing agencies like the Federal Housing Administration, a government guarantee of private mortgages triggered only when the market is in trouble, government insurance for mortgages that would kick in only after private companies fail to pay. Charles Wagner of CBC National Bank in Alpharetta, Georgia, says the proposals will need to be ironed out before a clear picture of the industry emerges.
In short term, it's a bad thing. Long term, it can be okay if we can figure out how to manage both credit risk and the investment of securities.
Whatever scenario is adopted will make buying a house a more expensive endeavor. The popular 30-year fixed-rate mortgage would likely go away, as banks would prefer adjustable-rate mortgages that fluctuate with the markets. Lending standards would also get tighter. Companies would require 10% down payments for all loans, and fees for government guarantees would increase. Geithner says support for the mortgage market would decline slowly over 5 years or more.
Describe this as, we're going to drive west. We're driving. Everybody wants to go west. We sort of know where we're going to go, but somewhere around Salt Lake City, we'll make a choice about what mix of ultimate options we're going to.
The plan also calls for changes to the national standards for the companies that collect borrowers' monthly payments. Those companies, known as mortgage servicers, admitted last year to foreclosing on borrowers without filing the required legal papers. Warren Levinson, The Associated Press.